Hi, everybody. My name is Buck Hartzell, and I'm joined today with the Motley Fool's Chief Investment Officer, Andy Cross, and our special guest, Ralph Andreda, who joins us as CEO from Bread Financial, who just reported excellent earnings yesterday on January 28th. Ralph, so thanks for joining us today.
It's a pleasure. We are very pleased with our fourth quarter earnings, and in fact, I'm pleased with the year. As we built a lot of momentum going into 2026, so we're very pleased with where we ended up.
Yep, and we have some other questions we're going to get to, but I can't skip over earnings. Just I'm going to summarize some things, and I know Bread is a company that I've recommended. I think it's a gem out there of a company that a lot of people perhaps haven't heard of before, and so I'm going to summarize some of the results that you reported yesterday. Tangible book value grew 23%, $57.57. Adjusted earnings per share grew 57% to $12.16. That's pretty incredible. And I could probably stop there, but I'm going to throw in at least one more. You reduced your share count 12% over the last year, which has to be in the top 1% of all companies that are out there. That's a huge reduction, 5.7 million shares, and you still have $240 million left on that authorization. I would add that the stock you purchased at about a little over $54 a share. It's over 70 today. So congratulations on that. And you raised the dividend 10%. Um, I've seen a lot of good things. You've lowered your cost of capital. You've paid down debt. It just was a wonderful year. And so I want to congratulate you on the team because I know that didn't happen. Luckily, you guys have been laying the groundwork for several years. You joined in 2020 to get there. So did I miss anything? Is there anything that you want
Oh,
to call out from earnings that maybe people should pay attention to that you don't think they give enough credit to?
I think we have a really good handle on expenses. We have, positive operating leverage. If you think about, credits moving in the right direction, all of that has been very positive for us. And we stuck to our knitting, focused on what was important, focused on bringing down our expenses with operational excellence and deploying capital as appropriate. I said everything you said. I think I'm going to hang on my mother's refrigerator in Brooklyn. I feel pretty good about it.
You got
Well,
to
I said,
you got to pay Buck for that,
Yeah,
Ralph. You got to pay Buck for that.
I'm
I said,
blushing. So,
I don't think Nvidia bought back 12% of their stock, and they're 57% growth. I mean, that's like kind of incredible numbers there.
You mentioned the tangible book value of 57.57. We're really pleased with that. And the stock we bought back was below that tangible book value on
Yeah,
average. And we feel
yeah,
really good. And, we have an authorization going into 2026. And, one of the things that I wanted to do when I first got here was really, kind of get our capital, our capital outlet, things in order, get what our priorities were. And it was really to invest in this business, to strengthen the balance sheet and then return capital to shareholders. And when I first got here, it was hard to do one of them. And now we
yeah.
have the ability to do all three and do all three effectively and still have that strong balance sheet. So we're really pleased with the momentum over the last number of years.
And that's a credit to you and the team. I mean, for doing that. And you didn't start at the easiest of times. So
No.
we're going to get in. You started in 2020, the start of a global pandemic. What a great time to make a switch. I mean, we're going to get into some culture questions here because that's important to me. I think anytime I do interviews, generally ask about culture. And there's a saying I usually lead off with, and it's accredited to Peter Drucker, but I think it might have been somebody else who actually said it. He said, "Culture eats strategy for breakfast." And I want to use that because I want to get to know a little bit more about the Bread culture and how that's changed since you came over. How would you kind of define culture at Bread, and what have been the big changes, since you joined at 2020 that you think that's maybe different about the organization than before you joined?
As you said, I joined February 3rd, 2020. I remember the day because it was my birthday that I joined.
Oh, okay.
Uh,
Yeah.
and so I always say I had 3 good weeks before the pandemic hit. So I had
Yeah.
really 3 good weeks with the organization. And,
Yeah.
in a lot of ways, the pandemic helped me shape the culture here, in a lot of ways, because I think you could do one of three things when you're faced with enormous challenges. Is one, stick your head in the sand and let it just wash over you, and the consequences are the consequences. Or two, you can kind of tread water and do the minimum amount due and kind of just keep out balancing. Or three, you could really take advantage of the crisis
Yeah.
and make change and transform the company because you're almost everything comes to the surface in a crisis. And that's what we chose to do. So
Hmm.
I was here 3 weeks. I didn't really know my leadership team all that well. I inherited a leadership team. And what it did is it helped me, identify, who the true captains, who were the field marshals in that team as we were trying to assemble,
Right.
a team to really manage through the pandemic. So I knew right away that, these people are keepers. I need to strengthen other areas of the organization and get, new talent and bring talent into the organization. Um, where we were short on product, what products did we have, what products didn't we have, what underneath the surface was going to hurt us from an investment perspective that came to the surface, partners that were, that we invested in that maybe weren't going to make it, how did we get through, all that gets accelerated
Right.
in the pandemic. But the first thing, we did was make sure that we had, our associates were safe and sound. That
Right.
was most important, and that's the message that we started with. Most importantly, are our associates safe? Can we make sure that all our associates are working or get the help they need if they've been, if they were hurt by the pandemic? We were very adamant that we would make sure that they were, taken well care of. And that's how we started this culture. I believe very much that, our culture, it's the value cycle. You have satisfied associates that drive good customer experience, that drive profitability, and you've got to give back to the associates. I believe in that service profit chain sincerely, and I think we've done a lot of good things. When I first got here, my first town hall, um, at that time, that somebody said, "Well, what questions do you want?" I said, "That's not the way I operate. I want people to get to know me, and I want them to ask me any questions that they have on their mind. I'm not looking for plans. I'm looking for any questions they have. In fact,
Right.
in all my town halls, I use an app called Slido, which is a
Yeah.
crowdsourcing app, which makes people, they can ask me anything, floats to the top. It could be anonymous. They get a little bit braver when it's anonymous. And I would answer that question, and my team, and we use it. And, one of the tenets of our culture is open communication and
Gotcha.
transparent communication and being approachable and authentic.
Yep.
Those are the things we've built this culture on, and being brave and being, and not and making people speak up. And I really like people that speak up. I like people that have the courage of their convictions. And no
Right.
matter where they are in the organization, I'm very willing to, consider their opinions. And that's how we operate. And
Right.
that really shaped our culture
It's
as we
it's
started
it's
out in
evident.
2020.
It's evident, I'd say. And there's a person called Willis Johnson, and Andy introduced me to him many years ago. He's the CEO of Copart and founder, and he's an interesting fellow. They run salvage yards or junk yards, some would call them, and have wonderful stock. And somebody asked him when they went public, "What is it like to be a public company?" And he had a great answer, I thought, and I think this relates to the way that your team has operated, certainly through the pandemic and everybody probably working from home and all these changes thrown at you. You can judge a lot by a culture. But Willis Johnson said, "You know what? It's pretty easy being public. You got these funny little guys that come down from New York in the funny looking suits, and they ask you a bunch of questions. You tell them what you're going to do, and then you go do it, and they're happy. It's pretty easy." And I'd say, like, since 2020, I've enjoyed following Bread. You've said what you were going to do early on, and you've done it. You've
Yeah,
done it all through some difficult challenges. So, congratulations on that. I'll pass it on to Andy, who might want to ask another question or so about culture.
sure.
Um,
Well, Ralph, I just wanted to ask. We'll talk a little bit. I hope a little bit about your products and your offerings
Sure.
as a financial company. But when you came on within a year or two of coming on, there were two things that you did, and your team did. One, you changed the name, and two, you started focusing much more on from a describing your company as data forward to tech forward. And I want to just ask about those two decisions and how the conversations came about and how you all reached decisions to make that transition, those two transitions.
Yeah, when I first came aboard, the then board had an idea of really refocusing the company to, where the money was, where the profitability was. And if you think about then, Alliance Data Systems was a holding company, and we had like four disparate companies. We had Epsilon, and we had, Air Miles in Canada, and we had I called it the Green Stamp Company in the Nordics, and we had the cards business. And if you looked at all four businesses, the cards business was the one that's generating capital and generating returns. But the other businesses took mind share and investment to keep them going, and their returns weren't as expected. So when I came on board, we had just sold Epsilon. So that was still in the process of being sold. So that was one that was gone. And during the beginning, and I looked at the companies in Canada, and we looked at the companies in the Nordics. And it's not core to what we do here in the States. We're core to what we do is we're a credit card company. We're a consumer credit card company. We're B2B to C, and those two businesses were disjointed. So we spun those off, in the first couple of years. And in the process of that, the first year I was left, we were missing a product. We were missing the buy now, pay later product, and a lot of our partners were asking for that. And we had a good first right of refusal, but if you don't have a product, nothing I could do about it. So they were going to other providers, and so we decided, early on, so we've got to, fill our product gap, and we had some product gaps in the organization, and one of them was buy now, pay later. And we looked at, do we buy, do we build, or do we partner? And building, given the challenges of technology and what we had to accomplish back then, building really wasn't an option for us. It's okay, maybe we partner. And we looked to partner with a couple of firms out there. And when you partner and you're a regulated organization, you got to own the customer, because if you don't, you open yourself up to a lot of issues and a lot of exposure, whether it's real or reputational, but there's a lot of exposure. So we decided to buy. It was the shortest distance between 2 points. So we looked at a number of organizations, and Bread popped up, and I love the name, and it was a New York-based company, which I also loved the talent that they had some really good fintech talent, and I joke, we met with them March 16th, 2020. March 17th, the world stopped. So that's when we met with them, right? So we bought Bread like this, I call it on TV. It was the what do you call it? The telechannel. We bought Bread. This is how we ended up buying it over time, and it really filled a gap for us. And and I thought about Alliance Data Systems. I was like, God, what does it mean? It doesn't mean anything. It has no meaning. It has no brand substance. In fact, the brand motto was the brand behind the brand. Mm-hmm. And I did not like that at all. The way I think about it, if you're not the lead sled dog, your view never changes. Yep. Right? So why would we be the brand behind the brand? I wanted to be the brand beside the brand, the brand leading the brand. That's where I wanted to be. So, we thought about names, and I looked at SoFi. I love that name, and Toast and all those names out there. I said, we need a name that is simple, that people will get, and has to stand for something, right? So, we bought Bread, and we said, what about Bread Financial? And we kind of tested it with our partners and some consumers, and we put it out there, and it kind of hit, and there's always the pun with Bread, and in our office in New York, all the offices are named after different types of bread.
That's great.
So I joke around. My office is called Crumb, but I joke. but the offices, and it just had a nice cachet, and then I got to do something that I never thought in my lifetime I'd do. I grew up very modestly in Brooklyn and New York, and always had I had a trip. I went to PS 229. I had a trip to the stock exchange, and we got to see how the stock exchange works. And lo and behold, I got to ring the opening bell at the stock exchange for Bread Financial. Something I thought I would, in my lifetime, I would never do. I got to sign the big book with J.P. Morgan signed. I got to climb the stairs. It was such a great experience, and the name took off. And we could have named it anything, but it's what it stands for, right? It stands for integrity. It stands for transparency. It stands for providing products that are useful to customers. It stands for making sure that we are frictionless when it comes to working with our partners, working with our customers, and we love the name, and we've got We've got so much branded gear now that we're really excited about it. Coffee cup shirts and the whole. And that's how we came up with the name Bread Financial. It filled the gap for us,
Yeah.
and then it just made sense to rebrand the company. And I remember speaking with some analysts, and as we were changing the company, as you said, we were making strides and keeping our promises. And one of the analysts asked me, said, "Well, why don't you think your stock's gaining ground?" And I said, well, let me ask you that question. You're out there. Why is my not stock gaining ground?
Yeah.
And they said, well, the name, in the past maybe disappointed
Yeah.
the community, and maybe you should have a name change. Maybe that would help. And I couldn't. My legal team wouldn't let me say it, but we were about to change the name 3 months later.
Yeah.
We've really enjoyed it, and we love we love the jokes. I think there was one yesterday, bread rolls. That was one of the analyst comments, and we
That's
love
good.
it, and we take that in stride. But it does stand for making sure that we're very focused on our customer, very focused on our partners, making sure we provide the right um, environment for our employees to
Yeah.
flourish, and that's what we stand for. So we always like to say bread's rising, and
Yeah.
that's how we think about it.
And Ralph, around that time, you did change to this tech forward
Yes.
attitude from just data.
Yeah.
With Alliance Data, it was a lot of data, and you made this pivot. So you made the name change, acquired Bread, and you started focusing on this tech forward mentality. And I think that will be threaded through our conversation
Yeah.
here. But just talk a little bit about that decision as well.
Yeah, a lot of my current team, we have a good blend of a team where we had, I call them historians, people that were here for a long time, and then we've brought people in, and I come from the big banks. I came from American Express and Citi, and very much focused on digital first. And I think that's critically important because you want to be where your customers are. You want to integrate. You want to operate with them where they are, and they're used to being digitally first. So we were a bit behind. So we really were
Mm.
moved forward on creating an app for us and really digital servicing and all the things you had to do become a digital company. And one of the things I'm really proud of is one of our partners, crypto.com, picked us because of our digital prowess. But again, we focus on digital first and ease of use and uh, being frictionless with our partners and customers, and that's where we go first, and we'll continue to do that. We have we've fashioned a new tech team. We're focused. We're moving to the cloud on pretty diligently, and we ask ourselves first, can we how do we digitize this? How do we digitize and be more where our customers are, be forward leaning when it comes to technology, and we've really embraced AI. And being a public company and being regulated, the first thing we had to do is like, what's the right governance we have to put in place for AI, right? Because we have customer data and we've got partner data, and that's got to be protected. That's number one, job one, protect that data, protect that information. So we put that governance in place of what can enter our ecosystem in terms of AI. And I'm proud to say we have 200 bots. We have forward-leaning AI. We record every call with AI. We do a whole bunch of things that help our employees service our customers so much better. And we're not on the leading edge. I call us a very fast follower, but we're practical about the use cases. And I said, how do we use this to service our customers better, to service our partners better, and to service our employees better? How do we make them more smarter and better so they can service our customers? And so that's the mindset we have, and that's how we go into that's how we approach every use case and every problem.
Yeah. And you mentioned moving to the cloud, and that's a big decision. You've made a lot of big decisions since you've been there. One of those was outsourcing to Fiserv and choosing them. And one of the things that I like to say about executives when I follow them is that they possess the capacity to suffer.
Yeah.
And what I mean by that is they think and act long term. They don't care about, hey, a bad quarter or two or whatever. Let's do what's best for the long term interest of the company, our customers, and our shareholders. And can you talk a little bit about how you make those decisions? I think moving to the cloud is one of those that can be a disruptive thing. You already did the Fiserv thing that caused a couple quarters of disruption.
Sure did.
How do you make those big decisions? And just fill us in on how the cloud migration is going.
Yeah, you got to look past the pain. That's what you got to look past that pain point because execution is, sometimes painful. And I've done a number of conversions, and they are, no matter how much you plan and how much you focus, something's going to happen, and you're going to have to address it. And I think most importantly, it's not about how it happened, it's about who made it happen. It's like you got to work the problem. And we knew that was going to be with Fiserv. Fiserv was the right move for us. We saw it long term. We were very insulated in terms of our technology, and when we had to make a change, it was very sequential. We couldn't do it across the enterprise with partner by partner by partner. Moving us to Fiserv really helped us in terms of being able to make that change across the entire ecosystem. What I learned is from Card Act, when Card Act came on, you had to make all these changes, and now if changes were going to come to the industry, we were going to make them at Fiserv, and we were going to be a user of those changes, not a developer of those changes. So that was really helpful. But the first 2 years were bumpy because it wasn't just a technology change. We were changing all our processes, and these processes were embedded for 20 plus years, and that was the hard part. We learned some lessons from Fiserv. I think in terms of trust but verify in terms of deliverables and how you get things done, and really think about getting the business involved up front. So, in the beginning, it was treated like a technology conversion, but it really was a business conversion. So if you think about what we're doing with the cloud now, the cloud it is a business conversion. We are changing our business. We are not just lifting and landing on the cloud. We're saying, how do we do this better? How do we get smarter about how we do acquisitions? How do we get smarter about payments? And you get the business involved up front, and they are part of the solution as you move to the cloud. And more importantly, we are not implementing a date. We're implementing quality. And I think that's the most important thing. We've got customer information. Our partners rely on us. We're going to go when we're ready to go, and we have surety that it's going to work and it's going to work well. And we're not implementing a date. And
Yeah.
that's, I think, the mindset we have now. And some of that was lessons learned from Fiserv. 2020 hindsight, would I do Fiserv again? Absolutely. It
Yeah.
helps us immensely. It helps us onboarding partners much, much better. When regulations change, if they change, it's better. Fraud tools that they're bringing to the marketplace are state of the art, and we get to participate in that
Yeah.
as a user of that technology. But to me, those were brave decisions. Again, we can tread water or we can move forward, and that was a move forward decision.
Right. Yep. That makes good sense.
Ralph, speaking of a move forward decision, the direct to consumer has been a big driver of your growth. It is now almost half of your funding.
Yeah.
It's really changed over the last 5 years or so. Talk a
Yeah.
little bit about the success of that. How have you achieved that, and where do you see that going forward as a contributor to your funding environment over the next 5 years?
Yeah, it's interesting. When I first got here, we had less than $1 billion of consumer deposits, and I was surprised by that. And we had two banks. We had one in Utah, and we had one in Delaware. And the one in Delaware we couldn't collect deposits on, but the one in Utah we could. And I was looking at my cost of funding, at our cost of funding, and said, well, if I take consumer deposits, I can reduce my cost of funding and still be at the top of the league tables in terms of offering rates to consumers. Now, and we're not a brick and mortar bank. We're totally digital, so I don't have a lot of overhead. And so to me, it was, I don't want to say nothing is a no-brainer. It was a decision to say, we're going to build a deposit base. And my challenge to the group was, I want to have a deposit base of 50% of my funding. I want it to be consumer deposits. And we are just about there now. So, we finished the year with $8.5 billion of deposits, which we were excited about. My view is I'd like to be at the 70% range for my funding. And again, I could be at the top of the league tables because, it's cheaper than my broker deposits and my other funding. So I can continue to offer good value to consumers. And we've built a really nice deposit base and a base that we can cross-sell to, that we can cross-sell, our products. We also have products, direct-to-consumer credit cards now, which we've never had before. So we have a 2% cash card, on the American Express network. Old habits die hard. But that's a really good product for us, and for American Express, we cast a wider net, right? Because we can
Yep.
underwrite a little bit deeper than American Express can underwrite, and we bring people into the fold. That's been a nice product for us, and we have a second product with American Express that's a rewards based product, and those products came about uh, because we were losing a partner. We had, I said, what happens when we lose a partner and we get to keep the portfolio? They said, well, we just let it run off. I said, well, that's not acceptable. Let's have a win back product. And we created that 2% cashback product with American Express, and lo and behold, it's over $1 billion. It's good receivables and it's got good customer base, and it's a product that is part of our portfolio. It'll never be the top of our portfolio, but it gives us the opportunity to offer consumers yet another way to finance purchases.
Yeah, yeah. And I want to ask a little bit about buy now, pay later, because this is an area I'd say within the Fool, there's discussion around this spot, and I have probably been one of the more skeptical people of some of the buy now, pay later stuff. I like Bread, and I recommended the company because I knew you guys came from a lending background, and I knew
Yep.
you specifically did. And but it's been some of a little bit the Wild West out there. And I'll give you some information, and then you can kind of tell me what you're seeing. And I know it's a small piece of bread, so I understand that. It was reported that 41% of buy now, pay later borrowers missed a payment in 2025. That's a pretty high number.
Yep.
And we know that they're extending into, other ways. I mean, Peloton was a big benefactor of people buying those bikes, and we kind of saw what happened with Peloton. And now they're moving into, I've heard, groceries and this kind of stuff for buy now, pay later. So can you just give us and shareholders an update on, like, what do you see going on in the overall buy now, pay later space? Are you concerned with it? And then I know you said in the conference call that you think that part will grow for Bread here in the coming year, but how do you grow that and do it in a way that's responsible?
Yeah, I appreciate the question. So, you know, buy now, pay later, in 2020, 2021 was a bit irrational, in my view, right?
Yeah.
They were giving merchants huge sign-on bonuses, and the merchant discount was not very high, and merchants were hot to get it because just there was nobody in the store, so the only way that they can get traffic was on their website, and they needed eyes on glass, and that's why I think buy now, pay later really took off. In 20 and 21. And listen, I wanted the product. But if you think about Bound Eye Parlay, there's two products in my mind. You've got Pay in 4, and that's, quite frankly, there's not a lot of profitability in that Pay in 4 product. You know, that's, that's not something that we have because if our consumer wants it, that's great. But where the opportunity for growth is an installment loan. That's where the real opportunity for growth is in buy now, pay later. And I mentioned in the conference call we added two really good partners: Vivint, which is home security and cameras, and Cricket Wireless. And that's where I think we're going to get some nice volume from, and it's installment loan. So we offer 3, 6, 9, 12-month tenors in installment loan and longer, and that's where the value is in buy now, pay later in my mind. You'll be happy to. We underwrite them like we would underwrite a card. So basically, we use the same, yeah, the same focus that we would to underwrite a card. So we feel that the people we're underwriting is the right cohort, and we're providing the right level of credit and to those people as we underwrite them. So I feel good. We'll grow that business responsibly. But to me, it is not our only business. It's one array of several products. If you think about where we are, where we were, and where we are, when I came here, we were private label credit card. That was kind of we were a one trick pony, and we had a couple of co-brands, but they were really painted private label credit cards. We painted them co-brand. If
Yeah.
you look about the portfolio now, right? I think private label will always be a part of us. I mean, that's where we started. It'll always be a good part of our portfolio. We've really grown our co-brand business. We have the proprietary products we mentioned before, and we have buy now, pay later. We have installment loan, Pay in 4, and now we're just moving on personal loan. So we have this array of products, and wherever the consumer is in their borrowing lexicon, we can lean in on that product. So if buy now, pay later installment loan is is in vogue, we can lean in on that product. If co-brands is vogue, we can lean in on a product. And if you think about a portfolio now, over 50% of our spend is in the co-brand and general purpose spend. So we've really shifted the risk. We've really shifted our product mix over the course of the last 5 years. If we had stood still, we would have missed out on all of this general purpose spend if we were still private label. So I'm really pleased with how we've diversified and de-risked our portfolio.
Right, and the top 10 clients that you have are renewed through, I think, 2028. So
And beyond, yes,
yeah,
we are
and
really
beyond. So
excited about that.
that's a great thing. And one more thought that's been a concern of mine, and this has been in the news over the last year or so, is really about the buy now, pay later lenders, not necessarily reporting to the bureaus in real time. And there's been some news or articles about some were okay with doing it, some weren't okay, and they were saying they wanted to protect their customers and that kind of stuff. One of the things that's, I think, a concern out there is the potential for loan stacking to go on, where maybe somebody goes to each of the buy now, pay later lenders, and because it's not reported in real time, you guys don't necessarily know about that. So how do you prevent those kind of things from happening inside a bread?
Yeah, I think so. I was so impressed when I got here with the way Bread Financial underwrites, right? I mean, I came from American Express and Citi, and I thought to myself, what's this small company could teach me about underwriting that I don't already know, right?
Yeah.
But I was humbled by the way that we approach the entire credit cycle, which I think is one of our strengths.
Yeah.
So we're a Vantage shop, we're not a FICO shop, and I would say convince me why we should be Vantage, and they did in a good way.
Okay.
But also, if you think about our relation with our partners, we have a lot of data that we work with on together. So we know how long people have been members of a loyalty program, how much they shop, what their habits are, and so we use that type of information as we think about underwriting. As we underwrite, and I'll even say with even buy now pay later, we assign the right initial line to the customer. So that's critical. The right line assignment, giving the customer the ability to spend, but not overburdening the customer with a line that won't be able to pay back, and a
Yeah.
line that we can manage. And I think,
Okay.
and so we have, our philosophy is low and grow, right? So we look at these partners, look at our customers, say we give them a line, and they grow with us over time, and then we provide maybe another product. Maybe they start with a private label product. We provide the co-brand product post that, but at very sophisticated in our underwriting. So we use the bureaus, we use all the information, and we use some lookalike models in terms of what behaviors might be out there. And then as these buy now pay later companies are reporting to the bureau, we use that information as well. So we feel we are taking the right risk for the right return on our portfolio as we underwrite, and that's been the philosophy here for a very long time. When I got here, I looked at the loss rate, which was higher than I was used to in my previous roles
Right.
in other companies.
Yep.
And then I looked at the credit margins. I said, okay, I get it.
Right.
And then I looked at our ability to collect and how we collect and how we go about it. And I said, well, it's a well-oiled machine from initial line assignment through spend through collections. It's a tight knit process, and we've been really impressed with how we approach that over time. And you can see as over time, we've said here's where we think credit's going to be. Here's how we're going to manage it. Here's what and
Yep.
we didn't go for the head fake when people's scores were inflated during the
Right.
pandemic. They had that extra cash. We kind of stuck to our knitting, and we didn't
Yes.
suffer those losses on the back
Yep.
end of those where we shouldn't have been underwriting. And
Right.
we've done a really nice job. I'm really
Yep.
proud of the team.
Yep. And it's a temptation to
Yeah,
change. So I
it,
appreciate
it,
you guys sticking to it. Yeah.
it was, and I think sometimes we would get asked by analysts why, when you're going to
Yeah.
open up the buy box.
Yeah.
And I said, our buy box is going to open up over time, and it's be gradual, and people are going to, we're going to do it when we feel that there's the right level of risk for the right level of return, and that's how
Right.
we think about it.
Ralph, maybe a similar answer. We see Klarna hit the IPO markets, European with its banking license, come over to the U.S. What about Bread Financial expanding more internationally? Is that a consideration, an option, or do you just not have the competitive dynamics locked in yet internationally?
We're a U.S. based company, small but mighty. I've run international card businesses, and it is hard to compete with the national bank. In fact, when I was at American Express, I was the international CFO when we ran the cards business. But you never could beat, the Bank of Brazil, and you can never beat them because they own the market. And I think that was how American Express came out with that, global network services model. So for us, I think our market is, within the United States. I don't see us expanding, internationally. The only thing I see as potentially is, our bread platform. If somebody wanted to use that and our underwriting capabilities and they wanted to hold a receivable, that we can do because that's a
Yeah.
fee-based business. I like fee-based business, little
Yes.
risk and little capital, right?
Yes,
So that's
exactly.
something that, I would consider, but it's hard to compete with the big boys and the local banks, the national banks
Yeah.
in some countries.
You mentioned, Ralph, the fee based business. The other part of the business is the spread business, and you talked a little bit about this on the last call. With we're taping this. We have a new at least Fed nominated chair here as of this morning as we tape this. And just thinking about the interest rate environment, probably a lot of questions that our viewers might have. Just how you think about navigating that. You mentioned that if rates are going to go down, that will impact the net interest margin a little bit for Bread Financial. Talk about those dynamics with the interest rate
Yeah,
environment.
listen, we're a little asset sensitive, but we're hedged and we do all of the things you would expect. We have a terrific treasury department that makes sure that we're accommodated. And when the rates go down and we'll see the rates come down in our bank, and we'll pay less for CDs and those types of things, not gradually, but I think we'll be able to weather the storm. Our plan in 2026, accommodated, some rate changes. That's in our plan in 2026. We've considered that as we move forward. So, something we're used to in the business. I've been in this business for 30 plus years. We're used to rates going up and rates going down. So it's something we've contemplated, and it'll impact us, but not dramatically.
Yeah.
I mean, 4% on a high yield savings account I'm seeing on your website. I think that's more than I'm getting at one of your competitors. So, I mean, that's pretty attractive.
We're ready to take your business.
There you go. And we're going to finish up kind of the business section here. Maybe we'll do one question each for Andy and I. And I'm just going to ask you, what's the biggest opportunity that you're excited about in the coming years for Bread that you think's out there?
Yeah, to me, what I love about this business is sticking to our knitting is a great opportunity. Quite frankly, I mean, I think we win more than our fair share of partners. And if you think about the partners we brought on this year, we brought on Furniture First, Bed Bath and Beyond, Crypto.com, Raymore and Flanagan, which is kind of a big name in the Northeast, and we win more than our fair share, and I that's terrific. And our renewal rate is outstanding. We renewed many partners this year. Our renewal rates plus 90%, on the high 90s. So, like I said, our portfolio is secure for a very long time. Yeah. And just to introduce new products into that portfolio is important. A deeper penetration with our existing client base, bringing on new partners. I think those are really great. And then the application of AI, doing things smarter and better and cheaper, and making us, volume inelastic. So if we bring on partners and revenue grows, we don't get the expense growth. And we're smarter about how we manage that customer base, how we manage collections, how we manage all those things using AI and using intelligent technology. So that for us that's how I think we'll move forward. We always promise we're focused on positive operating leverage. Yeah. So revenue is going to outpace our expense base, and I think that's a real opportunity for us going forward, particularly with the application of AI and agentic AI, where we can recommend products to customers and be in that purchase path right up front. I think is really exciting for us as we move forward.
That's great, Ralph. That was going to be my just my follow-up. Was so much conversation about as companies spend more and more and they shift their tech spend towards AI. Where are the returns coming from? How are we getting ROI? Analysts all want to see it.
Yep.
And so I was going to ask you about that, but you kind of answered it. So I'm going to pivot and ask a little bit just about the future of electronic payments and moving and how money moves around the world with stable coins. You mentioned your partnership with crypto.com. Just talk a little bit about the Bread perspective as you see about different technologies emerging like stable coins.
Yeah, we're very focused on a stablecoin. And again, first thing we're focused on is what's the right governance around this new new payment opportunity. What's the right governance around it? Because that's important when you're regulated and when you're a public company, and that's always paramount to us. And for us, we think stablecoin will be it will be advantageous to us if customers want to redeem rewards in stablecoin and do those types of things. We're focused on dabbling and innovating. We have an innovation lab where we're trying different things and what might work. We're working with a partner or two. That's okay. If we had a stablecoin product out there, what might that look like? How would we take payments? How would we interact with the customer? Initially it's really it's more commercial, right? Because it's pegged to the dollar and it's really works very internationally. But for us, if it's where our customers and partners want to be, we'll be there right with them. And we're now have some use cases. And what you mentioned before is very important to us in terms of, are we getting the return for the investment in technology? And that's what we focus on. What's the use case? And we don't go after the shiny object. We say we look for we have a problem or a challenge, and we say, how does this technology solve our challenge, and are we going to get a return for it? Rather than say, let's buy this technology and then let's find a use for it. We say, here are our gaps. How is this technology going to help us? And is it the right investment for us? And and that's how we focus. And that's how we're focused on new methods of new methods of payment. So we think in the near term, stablecoin would be advantageous for us as we move forward. So, but
Great,
we're
thank you.
focused on it.
We say often sometimes, and we read a lot of calls, that there's a lot of solutions out there in search of problems.
Yes.
Right.
Absolutely.
That's usually not a good sign at the other time. So we're going to switch to our third and kind of final big segment, is really about capital allocation, because I think I've followed along since 2020 when you joined, that Bread Financial is becoming certainly a capital allocation story.
Yep.
We've mentioned you bought back $310 million in stock. You reduced your share count 12% over the past year. You have $240 million left on that authorization. You've also paid down and refinanced a lot of your debt. So I would just say I'd like to start off with just your philosophy about how you make, because you're generating more capital than you need to invest in those technologies and all that kind of stuff. And you've given us a glimpse. You've raised the dividend 10%. As you consider future uses of that capital, how do you prioritize those decisions?
Yeah, so our capital priorities are the ones I mentioned before, right? We're really to continue to invest in the business and technology, and that's priority one, right?
Yeah.
I think of our businesses, particularly the consumer businesses, the credit card businesses, as an oil tanker. You've got to continue to invest in that. You got to keep it moving forward. If you stop, you're dead in the water, and it costs you a lot to really jumpstart and reinvest. And we've gone through that. We starved this business of investment in the beginning, and when I got here, we had a jumpstart investment, and that's what we did. So we focused on that. I think that's always important. That strong balance sheet, for a consumer lending company is paramount, and that's critical to us. So our CET1 ratio is 13%. That's where we want to be. We manage our ratios very closely. We understand where we want to be and how we're going to get there. We have two banks, and those and safety and soundness is critical, and strength at the parent is critical. And we manage, and that's a day-to-day management. We manage that. That doesn't happen by accident.
Yeah.
And giving back to giving back to our shareholders is critical. So we weigh all that and say, what's the best use of our capital? And I love this. I have I often say I've laminated my capital decisions, in terms of, what's my return on investing here? What's my return on, returning capital to shareholders? What's my return on keeping it on the balance sheet? How do I think about that? And we did that because we had to choose. Now we don't have to choose. and that's a good thing. So as you said, we have more gas in the tank for the share buyback. We're excited about that as we move into 26. It's something that our investors, when I first got here, I had three questions from investors. What are you going to do with the international businesses? What are you going to do with your dividend, and when are you going to buy back shares? And now I can answer. Now we've answered all three,
Yeah.
and that's important for us. But we manage it together. Like what the
Yeah.
implications are, what are the outcomes? If I'm going to invest in this portfolio or buy a portfolio, what's the implications to my capital position from a balance sheet perspective? What's my implication to a share buyback? So it's very cause and effect, and we deal in outcomes. And that's what we look at. And we said to our investors over time we were going to we're going to return in the mid 20s, and we're going to have a loss rate of 6% through the cycle, and we're going to have this strong balance sheet, and we return value to shareholders, and that's what we focus on. So we don't focus on the quarter, we focus on the long term. But all those decisions, how they implicate us in the long term. So I'm very pleased with the talent we brought on in the finance organization that really helps me manage through those capital decisions.
Yeah. Yeah.
Ralph, along those lines, on those long-term thinking, when you think about the allocating of where to spend inside the organization, I imagine, or just talk to us a little bit about how the shift towards technology, maybe away from people a little bit, or is it still full blown invest in the people? Those allocation decisions on how you think about your expense level, how are you thinking about that going forward?
Yeah, listen, sometimes advancing technology has with a consequence, right, of less people in the organization. But to me, it gives the employees and the associates we have better tools to do their job and better tools to satisfy customer problems. And that's critically important to me, right? Because if our associates don't have the tools to do their job, they feel helpless. And then they feel hopeless. And that's not a place I want them to be. So we give them the ability and the leadway to help customers. And I feel like AI is helping them be better at what they do rather than replacing them what they do. I think one of the things, as much as we use AI and bots, one of the things that it can never replace is the empathy of an associate. I think that's important, I've listened to numerous calls, particularly of our collectors, when they speak to customers that are in trouble, and the empathy helps them get over the hump of helping that customer through a process. So I don't think that'll ever go away. We can get smarter at it. We can be better at it. We can be more predictive. We can have people self solve, but you're always going to need that empathetic employee to help people get through certain things. So yeah, we technology will replace some of the things that humans do. It's inevitable that will happen. But the people that remain, we want to make sure that they feel that they are vested, they're valued, they're compensated for the the decisions they make and what they do for us as an organization, and they have the right tools in front of them to do their job. At the end of the day, the business we're in, B2B to C business, we're a relationship business. We have relationships with the
Yeah.
partner,
Yep.
right? And that's critical. And we've driven those relationships beyond the marketing department. So our chief technology officer talks to the chief technology officers in all our businesses. Our CFO talks to the CFO in all the businesses. So our data people talk to their data people. So it is not just it's not just we're working with the marketing people. We're working with the entire organization.
Yeah.
And when we renew a partner, we talk about the pie, right? Years gone by, when we renewed a partner, we just give them a bigger piece of our piece of the pie. What we say now is we're going to grow the pie,
Right.
so the pie is bigger, and we both get a bigger slice.
Yeah.
And that's done through relationships and good technology and being innovative on what you're going to offer in the marketplace. So I don't view it as one or the other. I view it as integrated.
Yeah, I appreciate the pie metaphor, not the loaf of bread metaphor, but I was thinking the loaf of bread metaphor. But
bigger
hey,
piece of
whatever
Fair enough.
works, right?
I didn't want to get crusty on you.
I know. I appreciate that. Thank you.
Yeah,
Fuck.
yeah. That's great. And I'm going to do my last one kind of on capital allocation. You did increase the dividend and you spent quite a bit more on buybacks. Your stock's at probably 6 times earnings here
Yeah.
or so. And so how do you think about the dividend going forward? I know originally you came on, the dividend was was
Yes.
cut down. Now you're starting to kind of build that back up. Do you have like an optimal payout ratio, or do you say, hey, at this particular time, we think the stock's cheaper, so we're going to put more towards the buyback than the dividend? How does that work?
Yeah, I mean, we increased the dividend 10%, but obviously it was 2 cents, right?
Yeah,
So, but it was 10%,
yeah,
and it was the beginning of systematically increasing our dividend over time. That is in our in our long range plan to continue to increase the dividend. But I think we could do the combination, right? We could do buybacks as appropriate, and and increase the dividend on a on a steady basis, and that's what we intend to do. Now,
okay,
if there's a shock to the system, macroeconomic shock, all that.
yeah,
That's we'll take that into consideration. But
sure.
I think we're back to what's the steady, thoughtful growth of our dividend? What's the steady program of buybacks? And I think that's a good place for us to be, a place we weren't in 5 years ago.
Yeah, yeah, and that's great. And I'd say one of the things that I have a personal thing that I like. I tend to like companies that pay special dividends from time to time because that gives them some flexibility, depending on how things are going. But it seems that most companies and maybe most individuals prefer the regular quarterly dividend. But I personally think more could consider, given the ups and downs of some businesses, that just special dividends are nice too. Yeah,
Yeah. Good.
excellent.
Ralph, you joined on the day you joined. It was about $100 a share. Bread was about $100 a share. It's getting back towards there, but just maybe quickly culturally, as you go through an experience when the stock drops from 125 down to 25 over the course of a very short amount of time during the COVID period and the aftermath of that. Talk to us a little bit about internally, culturally. How do you talk to your team? What is that experience like?
Yeah, so when I get out of the fetal position, I come to the team, and listen, nobody likes to see their stock drop. But if you think about when I joined, we were a much different company, right? We had the international companies. We were just coming off a pretty rough time on the buyback and the credit issues. So I didn't expect it to be where to stay at that number. I tell the people internally almost sometimes to ignore the stock price on a daily basis. Although I know it's difficult to do that, we're in this for the long term. And we're going to make decisions for the long term. And we're not making decisions for a quarter. We're not making decisions for half a year. We're making decisions for the long term. And if we stick to our knitting and stick to our guns, those decisions will inevitably drive the stock price. And that's what we've seen. That's how we've seen. And I and I'm very transparent. My family's wealth is here, in driving this company, and it's important for us, and we're going to do the right things, and we do the right things over the long term, because the shortcuts never work. You get a little, happiness is fleeting, satisfaction is what you want, and to me, steady growth, responsible growth, is important, and you mentioned it before, Buck, promising the market and delivering on what you're promising. Not over promising and not delivering, not under promising and over delivering, but having credibility in the marketplace. This is what we're going to do. This is how we're going to do it. This is the time it's going to take. And I think that steady as she goes. So I'm very happy. And I knew we would have to, spinning off businesses and selling businesses, we would contract to grow. And I think that's what you're seeing now. So,
Yeah.
with 6 times earnings, if you ask me, very selfishly, I think we're a bargain in the marketplace. To be very honest with you, and we're focused. We have a good capital plan. We have a strong balance sheet. We have a terrific bullpen of partners. We have a solid, robust a pipeline that we're working with, and we're very focused on developing AI and developing new products for the organization. So, as I said, I'm really pleased about how we exited 2025 and how we're entering 2026.
Yeah. Well, I agree with that. And I thank you for sitting down and answering questions. And I think to myself, that says a lot about the culture at Bread and about how transparent you are. So we appreciate that. And we hope to certainly do this again. We're going to move on to our final segment now, which
I'm
is
looking forward to it.
okay, which is something we call buy, sell, or hold. This is fun. We just want your quick reaction on a bunch of these. So I'm going to give you the first one. Since you're called Bread, buy, sell, or hold rye bread.
Sell.
Me too. I'm a big
Wait,
seller.
is there a rye conference room?
There is. You know,
That's
I'm Italian, so we have ciabatta. We have a lot of Italian conference rooms too.
There we go.
okay. All right, good.
Focaccia,
Focaccia, we
ciabatta.
have exactly.
Yeah.
Okay.
How about pumpernickel?
We
Pumpernickel?
have a pumpernickel conference room.
Okay. There we go.
Nice. A baguette. Really, you can't beat a great baguette
100%
in
with
my
that.
in my book.
Aye. In fact, baguette is the name of our boardroom.
Okay. Nice. Nice.
Ralph,
Okay.
how about buy, sell, or hold 100% distributed workforces?
Hybrid buy.
Hybrid.
Okay. Good. Good. That makes sense. I'm going to go to buy, sell, or hold. Agentic AI agents will completely replace loan officers.
I'm going to hold. I don't. Again, there's not that empathetic part.
Okay. Yep. Got it.
How about buy, sell, or hold? AI-driven alternative data sources will make FICO obsolete.
I'm gonna sell that. I think just the enormous amount of information FICO and Vantage have,
Yeah.
and the history that they have is hard to replicate.
Yeah.
Okay. And I'm going to move on to the last one, and this is an important one, particularly for you. Your Siena Saints, which right now are 14-7, 7-3 in conference for the men's basketball team, will make the NCAA conference tournament.
I'm gonna optimistically buy.
Yeah, I like that. Yeah, I like the option. They're there. They're at the top third of the pack. They can certainly make a run. Well, we thank you on behalf of Andy Cross, myself, and the Motley Fool. We thank Ralph Andreda from Bread Financial. Ticker, for those of you who are out there interested in finding more about Bread, is BFH. So you can find it out there under that ticker. Thank you, Ralph, for spending time, and we look forward to chatting with you again someday.
Andy Buck, thank you. It was an absolute pleasure. Thank you so much.
Happy birthday, early birthday, and early anniversary. Full anniversary for joining Bread.
Thank you very much.
Yep.